Buy, borrow, die tax strategy, the missing step. The tax strategy buy, borrow, die is known by many taxpayers and widely discussed on the internet. But most taxpayers who should be using it are not. The result is higher taxes and less wealth created. Hi, I'm Dave Horwedel, CEO of Torchlight Tax. It is well known that many very wealthy people pay very little tax. In this video, I'm going to explain the primary tax strategy that allows them to do that. Buy, borrow, die, in a complete and clear format. Then I will explain the missing step that prevents most Americans from implementing this powerful wealth building and tax saving strategy. First, I'll clearly explain the buy, borrow, die strategy as it was originally intended. The buy, borrow, die strategy is not magic. It simply takes advantage of how the U.S. tax code defines and taxes income. Federal taxes apply only to income, not wealth. So, if you can create wealth without creating income, you are on the right track. Step 1, buy appreciating assets. You begin by buying assets, typically things that appreciate over time. This includes stocks, real estate, or private business shares. Once you own these assets, their increase in value over time is not taxed. This is called unrealized gain. The gain only gets taxed when the assets are sold and become realized gain. Let's say you buy $1 million in real estate and over time it appreciates to $2 million. You haven't sold it, so you haven't realized any income on the sale. There is no income, therefore there's no tax. Yes, there may be a small income if you rent property out. However, there are many deductions for rentals, and in many cases there is no taxable net profit. This commonly occurs even when the property is making enough money to pay the mortgage and generate cash flow. Step 2, borrow against the assets. Now let's say you need $500,000 in cash. You could sell the property, but that would generate a $1 million taxable gain and you would lose the asset. Instead, you go to a bank and borrow $500,000 against the property. That $500,000 loan is not income. Under the tax code, borrowed money is not taxed. If you reinvest this money, the loan interest may be deductible as a business expense. You now have the cash you need, and your assets continue to grow. You expect the real estate to keep appreciating, and you still own it. In many cases, the income generated by the assets, e.g. rent or dividends, covers the loan interest. This is the heart of the strategy. You live off loans, which are tax-free, while your wealth compounds. Step 3, die owning the assets. Eventually, you pass away. Under current law, your heirs receive the asset with a step-up in basis. For a married couple, this can be up to $27.98 million tax-free to your heirs in 2025. What is basis? This is explained in my video, What is Basis, on my YouTube channel, which you can click on in the description below, or you can just keep watching as I summarize the definition of basis under U.S. law. You can also contact Torchlight Tax for a free consultation at 877-758-7797 or info@torchlighttax.com if you do not want to study this, but do want a tax savings. Basis generally represents your capital investment in a property for tax purposes. It is typically the cost of acquiring the asset, including the purchase price plus related costs like commissions, taxes, freight, installation, testing, and legal and accounting fees. When you sell an asset, the basis is used to calculate whether you have a taxable gain or a deductible loss. The difference between the asset's sale price and its basis, or adjusted basis, determines the amount of capital gain or loss subject to tax. Let's move into the future. Let's say your property, which you originally paid $1 million for, is now worth $3 million. That is its fair market value. Let's suppose your basis in the property is now $1.2 million. If you sell the property for $3 million, you pay capital gain tax on $1.8 million. But if you die, your heirs get the asset tax-free. This is because the asset's tax basis was reset to the fair market value at your death. This is buy, borrow, die tax strategy. Buy appreciating assets, borrow against them, tax-free. Die and pass them on tax-free to your heirs. It is elegant, powerful, and completely legal. It also works very well for wealth building, as at high income levels, federal taxes go up to 37%, and with state taxes can hit around 50% of your income. The flaw in buy, borrow, die, why most people can't use it. Now let's get real. Why don't most Americans use this strategy? Step 1, buy is the main bottleneck. You need to already have money to buy assets. You need a down payment. You need credit. You need surplus income. If you're living paycheck to paycheck, how are you going to buy $1 million building or $100,000 of stock? Moreover, the strategy only works well if your assets appreciate fast enough to outpace the cost of borrowing. This can be a secondary bottleneck to some. And what if you can't get a loan? This is another potential roadblock. The strategy assumes you can purchase assets, invest them profitably, and borrow affordably. Not all Americans can do this. So what's the fix? How can you use this strategy? Create, borrow, die, the real beginning of wealth. Here's the missing step. If you don't already have appreciating assets or cash or credit to buy, then you must create them. This is sometimes called sweat equity. This is what entrepreneurs, founders, and creators do. Example, Elon Musk. Elon Musk didn't start with $1 billion to invest. He started with an idea and a company. In 1999, Musk co-founded a company called X.com, which was an early online bank. It later merged with Confinity, and together they became PayPal. Musk was eventually pushed out of the company before the IPO, initial public offering, but he retained a substantial equity stake. When eBay acquired PayPal in 2002 for $1.5 billion, Musk walked away with over $160 million. Did he retire and cash out? No. He rolled the proceeds into his next companies, SpaceX, Tesla, and others. He used his equity, not cash, to build these companies. Over time, those shares became immensely valuable. Musk doesn't draw a typical salary. Instead, when he needs capital, he borrows against his stock. He lives on tax-free loans, just like in the buy, borrow, die strategy. But he got there by creating the assets himself. This is the create, borrow, die strategy. 1. Create a business or asset with your time, skill, or sweat equity. 2. Borrow against your equity as it grows, tax-free. 3. Die, passing your equity to your heirs with a step up in basis. Musk didn't start with buy, borrow, die. He had to create before he could buy. Everyday example, Bob Jones. Take Bob. He works a W-2 job earning $60,000 a year, no spare capital. But Bob starts a side business, selling services, content, products, or rentals, whatever. He reinvests all earnings in deductible expenses and takes no profit from the side business. He builds his brand, goodwill, and customer base and lives off his W-2 income. Eventually, the business is worth $100,000. He hasn't taken a dime in profit, but now he has an appreciating asset. He borrows $30,000 against it, tax-free, and uses it to buy more tools, ads, or even another property. This is how real people build real wealth, by creating the first asset. It has many variations. Maybe Bob owns his own rundown house. He fixes his roof, landscapes his yard, adds on a room and patio, and paints and carpets his house. His house goes up $100,000 in value, and he borrows $70,000 as a down payment on a rental, which he now quickly renovates and rents. Now Bob is on the road to building wealth. He borrows and keeps investing. This requires skill and discipline. He must buy assets that go up in value. He must discipline himself not to waste his profits. He can also use advanced tax strategies like cost segregation and bonus depreciation to minimize his tax bill. See my YouTube videos, Introduction to Cost Segregation and What is Bonus Depreciation, links for which are in the description below. As his wealth increases, he follows advanced tax strategies so he can invest and generate more wealth. This wealth creation strategy is not that hard. The key is to start. If you have money to invest, great. That makes it easier. Grant Cardone has great strategies on how to build a real estate portfolio. I have attended some of his workshops and conventions, and if a person understands and applies his strategies, they can get on the road to wealth. Here at Torchlight Tax, we are experts on taxes and applying advanced tax strategies to minimize your taxes legally. The first step is to invest. If you do not have money to invest, you invest time. Maybe you work overtime and get enough funds together to buy a small rental. Maybe you start a small business and make income and invest your profits in deductible expenses like marketing and machinery so your business grows in value, but taxes are not generated. You can even lose money in the first couple of years and offset your W-2 income. The goal is to create an asset, whether an operating business or rental, that creates income. You can then create expenses that zero out the current income while creating future income. This pathway is not necessarily super quick. However, if you put your energy into increasing your net worth, not just your taxable income, and keep at it, you can build wealth. This strategy requires intelligence, persistence, and discipline. It does not require magic. The final layer, asset protection. Whether you're following buy, borrow, die, or create, borrow, die, one thing remains true. If your assets aren't protected, you can be wiped out. If you lose a lawsuit, or go through a divorce, or some other calamity, your equity can vanish overnight. That's why asset protection isn't optional, it's essential. Here's how we structure protection. Use LLCs for business or real estate to separate personal from business liability. Use irrevocable trusts to remove assets from your estate and shield them from lawsuits. Use a revocable trust so you can protect your estate from being looted in probate court and still retain control of who your heirs are. At Torchlight Tax, we design your tax strategy and your asset protection plan together, because there's no point in building wealth if you can't keep it safe. Start with create, borrow, die, then graduate into buy, borrow, die when you've built enough wealth. This is the full journey, from nothing to legacy, from taxes to nearly tax-free. And it starts not with buying, but with creating. To learn more, check out our Torchlight Tax website and YouTube channel, where we have hundreds of articles and videos on tax and asset protection strategies. We also have some video series on our YouTube channel that take a deeper dive into data you can use to increase wealth and decrease taxes, such as bonus depreciation playlist, real estate investor tax strategies, asset protection with Torchlight Tax. Contact Torchlight Tax for a free consultation at 877-758-7797 or info@torchlighttax.com. If you found this video helpful, please like it, share it, or subscribe to our YouTube channel.